The McAlvany Weekly Commentary covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, today you're in New York. I know you have the CNBC interview tonight on CNBC Asia at 6:40 p.m. Eastern Time. What are you going to be talking about?
Kevin, it's appropriate that we're talking about commodities, particularly since Asia and China specifically are the main drivers of a lot of your commodities. And if you look at commodity pricing over the last 6 to 8 months, you've seen not only a trailing off or a decline in Asian equity prices, but also in a lot of your commodity prices, be that industrial commodities and even some of your agricultural. So I think there is a trend, and it speaks to an economy both in Asia, in Europe, and in the United States, which is not, in fact, in recovery, although that's what we're being told to believe and to hope for.
Well, and David, I would imagine you're going to make the distinction between commodities and money, in this case being gold, because the Chinese and the Indians actually have been buying gold with both hands at record amounts while the commodity prices on the other commodities have been falling. So maybe you'll have a chance to make that distinction as well.
Yeah, no, clearly there is a different market. I did an earlier interview with a group here that deals with hard assets, fairly bullish on the commodity space altogether, but we were pretty much in agreement that gold is your standout because it is, in a low real rate of return environment, the place where people go, and particularly as we move into 2012. When we look back at 2012, I think we'll see it as a transition year, Kevin, between what was a European crisis and what is becoming a U.S. crisis, but there is this significant component in terms of the global economy, which is Asia and specifically China, and the contribution that everyone is hoping that China will make to the global economy as we sort of pull ourselves out of the malaise and get back on its former growth trajectory. Not, in fact, what we think will happen, but 2012 will, in essence, be that transition.
Well, David, there's an understatement to say that this last 4 or 5 years has been fascinating. In the scheme of things, after looking at the last 2.5 or 3 decades of debt growth, and it was unstoppable until about 2008, 2007, 2008. But here we are. I saw the cover of The Economist a couple of weeks ago, and, it had a little cartoon on there, and it had a little sign, these adventures, and the sign said, "Recovery at last?" And these guys said, yeah, after 5 years, we've been hearing about recovery. Initially, it was going to be the Federal Reserve and all the money that they were infusing. And then after that, we've looked towards Asia and their growth. Well, maybe Asia's going to pull everybody out. We need to have somebody. But, the new talk right now, David, you've got an iPhone, you've got an iPad, we've got laptops that are Apple. The world seems to be going everything for Apple. Apple's got $100 billion in cash. And, you're starting to see these commentators at this point saying, okay, well, if it's not the Fed and if it's not Asia, maybe it's going to be these corporations who have a tremendous amount of cash just sitting in reserve right now. They're not spending it.
So perhaps symbolically we could call this the recovery. It's Apple with
right.
$100 billion in cash, and not only will they likely be the first $1 trillion company, or at least so we are told.
Now, wait a second, David. There were other $1 trillion or Deutschmark countries, in the past. We certainly saw one in the Weimar Republic, or we saw many of them as the currency collapsed.
And more recently in Hungary, more recently in Zimbabwe.
Right.
So you're right, we have had $1 trillion companies before, but it's going to take a cash hoard far larger than the $100 billion in cash to get us on recovery. Nevertheless,
right.
The pundits would have us believe that recovery is nigh, and all we need to do is incentivize companies to spend. Will that be the catalyst?
Well, I'll bring this up, David. Right now, these companies are sitting on cash for some unknown reason, because we know that cash is devaluing on an annual basis by at least 2 to 3%, according to what the government tells us. But we know that inflation's higher than that. So obviously, there's some reason that they're willing to give up that opportunity cost. And, you've been skeptical about these companies coming in and just blasting the economy with a bunch of new capital. What causes that skepticism, David, and why are they sitting on it still?
Well, we've seen growing cash on the balance sheet since around 2000, 2001. So it has failed to materialize up to this point. But you're right, we do remain skeptical. I think as corporate chiefs are making some key decisions as to how to invest and anticipate the future, they're looking ahead and they're seeing both tax and regulatory uncertainty. And you've got to know that both tax uncertainty and regulatory uncertainty is a major component for them as they're trying to figure out how, when, and where to invest. Even if, under a future Obama administration, taxes go down, because that's what he suggested for manufacturers at least. You've got for individuals the Bush-era tax cuts, which will be sunsetting. And, Kevin, this is consumers facing higher levels of taxes, which, of course, is going to decrease their ability to spend and make a larger contribution to the economy. So you see corporations have to take that into account as well, the hamstringing, if you will, of individual investors as they deal with a higher tax burden.
Well, and David, we also have this massive legislation that's been coming through. We've got Dodd-Frank, we've got FATCA, we've got these capital controls that are coming on. I mean, if you're a company and you're trying to figure out how to invest your money and you have no idea whether the government's going to be confiscating something that you're doing down the road, it reminds me of the Napier interview last week. You know, the government will get paid one way or another. You're going to be doing the paying.
Well, and what happens, Kevin, we've looked at 1933 to 1940 as a period where, with massive, in fact, draconian legislation being put in place, 40 monumental pieces of legislation, there was cautious spending from private investors. In fact, private direct investment all but disappeared in that period. And not only was there market volatility, but there was a response to the confiscatory nature and an actual threat, a perceived threat to private property, given all of these pieces of legislation. And this idea of regulatory and tax uncertainty, they touch a similar nerve. They touch this nerve of private property rights. And these are issues which, if they're left unresolved, keep capital on the sidelines.
Well, David, isn't it an illusion anyway when we talk about corporations, or you hear on financial TV that these corporations have all this money that they just can't wait to spend, they're just not doing it quite yet? That's a historical illusion that could actually happen. I mean, one of the worst periods that we've had in the last century in the stock market was actually a period of time where the corporations had quite a bit of cash, wasn't it?
Well, and it's not so much that it could not happen. It's that the impact is meaningless. It's insignificant. The last period of time where corporate liquid assets reached these levels relative to total assets, which is about 6.5% to 7% of their balance sheet, was 1963. And in spite of spending those cash assets in a massive reduction relative to total assets, equity prices did not move considerably. We went into a bear market. So corporations were spending through their cash hoard, and that did not prevent us from going into this structural bear market circa 1966, and we didn't come out of it for another 19 years, at least from the 1963 period. In fact, we didn't see a real recovery begin in equities until 1982. So the argument simply does not hold. Companies spending their cash hoards, it's not on a scale large enough to be the primary driver of a secular bull market in equities. You're talking about something much more fundamental, something like a shift in the credit markets. And in fact, what we have now is a shift in the credit markets the wrong direction.
Well, and I'll tell you, Dave, the thing that's also interesting is that period of time that you're talking about, the early 60s all the way through the early 80s. That was a period of time where the stock market did relatively nothing, like you said. But if you were holding an ounce of gold, it actually outperformed the stock market 30-fold. And so there were profits to be made during the period of time when these corporations were sitting on large amounts of cash and the equities markets, weren't moving. But they certainly were not in equities.
And I think it's really important to look at that period because it resembles quite remarkably this period in time right now. 1966 to 1982, that period and the period of time that we're in now, the stock market didn't crash. We weren't talking about it getting cut in half or down by two-thirds, a la the Great Depression, 1929 crash, where it was actually down 89% at its worst. No, it just moved sideways. It didn't move anywhere for many, many years, in fact, nearly 2 decades. And in that period of time, inflation went from being on no one's radar, 1966, to on everyone's radar by 1982. And that got fully priced in to asset classes, with equities getting crucified and gold and silver doing very, very well on an accelerated basis as time went on. So we are in this similar period of time, Kevin, where a period of low real rates of return, where you're factoring in taxes, which we were talking about earlier, and inflation, which we regularly comment on, these factors edge away or take away from your real rate of return, what you get to take home. And that is the perfect environment for investors who want to move capital out of the stock market, out of the bond market, into, and there's the big question mark hanging over them, what do they put it into? Is it treasuries? Is it euros? Is it Australian dollars? Is it Canadian dollars? And this is where many investors, not all, but many investors conclude they don't want to take the currency risk. They don't want to fool with other fools, not just our Fed and not just the ECB, but any other central bank that's determining the course for any other foreign currency. Just keep it simple. Follow the KISS principle and move to metals. That's been the classic move in a period of low real rates of return, is into gold specifically.
Once again, you're listening to the McAlvany Weekly Commentary at McAlvany.com, McAlvany.com. Well, and if, David, we were to go back in a time machine just to the early 80s, okay, let's go back to the Reagan years. What you were seeing at that time was the very beginning of a credit boom. Interest rates were about to start to come down and fuel a credit boom for the next, well, at this point, about 30, 31 years. We're to the point now where we can't go much lower, obviously. So where is this credit boom going to come from?
That's the absurd thing, Kevin, about where we're at today, because we've got record low rates, not record high rates. We're at the opposite end of the spectrum. Credit can't do anything, but as our guest last week suggested, from here it can die, but there is no recovery in the credit market. There is no place for interest rates to go but up. Now, what kind of a time frame it does it, we don't know. But you look at corporate executives today, Kevin, and back to the issue of their cash hoards, our point is that they have a motive to hold on to their cash and build a war chest.
Sure.
If we can reflect on the value extraction, if you will, taking place by executives as they liquidate stock, their own company stock, aggressively into this last rally, this is not when those same managers would be going out to pay high prices for assets for the companies that they manage. Do you see what I'm saying? There's this notion that we want to better our own balance sheet by getting liquid and staying liquid and taking advantage of these high prices. It's the exact opposite of those companies using that cash war chest to go out and buy, via mergers and acquisitions, assets which are equally priced relatively high.
So, David, you're saying we need a credit boom. I mean, if interest rates right now were like they were in the early 80s, I remember my wife and I got a mortgage. It was our first house after we got married. Our mortgage was in the double digits, as far as the interest rates that we paid. So we were seeing high interest rates, and really, most of our adult life, our married life, we've seen interest rates coming down to this level. You need a credit boom.
You need a credit boom if you want a secular move. By secular, we mean long-term, years to decades kind of a move. You may have a cyclical upturn in the equity markets, but nothing that's sustainable beyond months, not measured in years and decades. The secular moves, the big picture moves, are driven by the credit markets. And if credit's expanding, guess what happens? You see a massive boom economy-wide. Credit's contracting. You see a massive bust economy-wide. And that's, in fact, what the Fed has been fighting, is this deleveraging, this deflation, if you will, within the credit markets. And that's a concern which still has to be played out. As we've noted, deflation is one thing that does hit commodities very hard, gold being an exception. If you look at the purchasing power of gold over the last 350, 400 years, spanning both British and American history, where gold played a significant measure, and we have to go back that far if we're going to be looking at gold and how it behaved in a deflation, it did very well. Minimum 30, 45% increase in purchasing power, maximum 250% increase in purchasing power in the context of a deflation, in the context of system-wide deleveragings. So I think, Kevin, the markets have to run their natural course, and they have become, the equity markets at this stage anyways, have become over-dependent on fresh promises of fiat money coming from the Fed and ECB, other short-term fixes that the central banks of the world have offered. The markets have not run their natural course, and they still need to.
Well, and I'll tell you, David, this is a time to maybe look at where that cash is anyway. We know the companies have been rehiring employees. Okay, some of these companies, like Apple, they are expanding, but they're hiring people in foreign countries. As far as the U.S. employment numbers, that's not very helpful. But the other thing that we need to look at is, where is this cash? We talk about almost $100 billion that Apple has, and then Microsoft, about half of that, and, Cisco Systems. These companies do have a lot of cash, and we as Americans have a tendency sometimes to just look through a monoscope. We just look at America and we say, well, why isn't that cash going into U.S. equities? Are these companies, you had mentioned gold doing well during a deflation. Are these companies just holding cash elsewhere to hedge against the dollar? Is it a currency play?
Well, you've got a couple of things. As you mentioned, they are rehiring. The rehiring is happening on a more global basis. So we've seen some changes in China with an increase in labor wages there and a diminished advantage for that sort of labor wage arbitrage, if you will, where you manufacture and produce in different locales and have a lower input cost into the products that you're producing, which gives you a wider margin and larger profits. But so that is being squeezed a bit. The new hiring for U.S. corporations, much of it is still in low-wage zones throughout the world. Mm-hmm. You're also right, Kevin, to look at these cash balances and see that out of the roughly $1.9 trillion in cash, I've seen estimates as high as 3.7, and I've never been able to confirm that, but a minimum of $1.9 trillion in cash, $700 billion of that is sitting in other parts of the world. It's overseas. So Apple's $100 billion, close to 60, almost 70% of it is overseas. Microsoft's $52 billion, 89% of their cash is sitting overseas.
So they're almost completely international. Microsoft at this point, 89% of their cash is overseas. Why are we even considering that an American boon to the economy?
Well, and again, Cisco, Google, Oracle, Qualcomm, Amgen, these are companies that carry anywhere from 48, again, to close to 90% of their cash overseas. So, there's a couple reasons they would do that. From a tax standpoint, there is also the issue of perhaps they're embedding a currency hedge, if you will, into their own balance sheet. The point on taxes is simply this. They don't get to avoid the taxes. It's just as long as they're retaining the earnings in their foreign subsidiaries, they're not paying taxes on that income. It's when the earnings are paid out to their company or distributions are made, repatriated, so to say, that it becomes a tax issue. So they have a motive to hold cash overseas, partially on a tax deferral basis, but also because they have a growth model which implies the rest of the world, frankly, is more important than the domestic economy from this point forward.
Well, and Russell Napier last week, it was a very sobering interview, but one of the things that Russell Napier was stressing to the people who were listening was, if you want to hold on to your assets, you're going to have some assets overseas. I think what we're seeing at this point is that we're seeing corporations make that natural transition just for survival. And, Russell Napier was addressing the investor, but I guess what we're seeing here is the corporation take that same advice.
Kevin, I did an interview with Bloomberg in the first quarter of this year, and the conversation, this was for their print media, and the conversation revolved around currency hedging and currency trading and how these multinational corporations used to just sell widgets, and they occasionally would have commodity hedging or trade desks where, because they have these massive input costs, whether it is a particular commodity like oil or nickel or aluminum or what have you, they would try to hedge their bets, so to say, and not have the impact of price volatility in that commodity impact their earnings. Now, with being international operations generating much, even in some cases the majority of their revenues overseas, these corporations are having to retool and develop their own currency trade desks. It's becoming a needed phenomenon to diminish the exchange rate volatility for their earnings.
Well, David, your family has always looked at adversity and said, okay, where's the opportunity? How do we survive this? Where's the opportunity? Your dad was like that. You're like that. But, we go back, we read the book When Money Dies, okay, and we look at the Weimar Republic as the currency completely fell apart. And we think, oh my gosh, everybody must have just been devastated. But one of your favorite characters in history, a guy named Hugo Stinnes, actually became fabulously wealthy during that period of time using this same strategy. Isn't it about the same strategy that we're seeing?
Kevin, it's fascinating because it could be that foreign currency revenues for many of our current day corporations are the means by which they outlive their states. In other words, a multinational corporation with its headquarters in the United States that's generating 20, 30, 40, 50% of its revenues in foreign currency terms, that may be the means by which it is actually a healthy, viable going concern long after the extinction event takes place, either for the domestic currency or for a bankruptcy event within that country. Hugo Stinnes is a case in point where He ventured into a very risky investment. He bought a steam engine in Great Britain for £3,500 and used this steam engine to curry coal from Germany, his home country, into France, where he developed this foreign currency revenue stream. And as the German mark was imploding and equity values were collapsing along with the currency, only on a slightly slower basis, he was able to take his French franc revenue and end up buying close to 2,500 companies in his domestic German economy. I look at what we see in terms of balance sheet exposure, the cash quotient or the cash portion that's developing in these multinational corporations, Kevin. And there is a ring from history. There's an echo from history. Cash flows from outside of sort of an economic conflict zone, if you will, are very interesting.
Well, all right, now I'm going to shift gears here because we've been talking about equities, and I think probably, there are certain things that a person can look at with equities if they choose to look outside of their country that are telling signs. I'll give you an example. Okay, the emerging markets. The emerging markets peaked out about a year ago. Now, what does that tell us? Is that a vital sign, or is that something like taking a pulse where we can say, okay, there's been a change. How does that affect the U.S. market?
Yeah, it's clearly the emerging markets having peaked a year ago is a little bit of a canary in the coal mine. With a direct supply of artificial stimulus was less, and we've had more supply into Western economies of Europe and the United States. Developed markets are now beginning to sputter as that quantitative easing and other forms of stimulus has had its effect. It's run its course, and it's now through the system or simply not making its way into the system. And investors continue to wait and see if a fresh round of artificial stimulus is coming. As we recorded 2 to 3 weeks ago on the commentary, insider selling has been and continues to be at near record levels. In other words, someone, and we're not just talking about anyone, but the corporate executive, CFOs, CEOs, COOs, CIOs, believe that the Dow 13,000 is priced high enough, that is. The S&P 1400 is a good price, good enough, that is, to be selling at.
Sure, and these would be the guys who would know. The guys who would know would be the guys who are running the corporations. But do you think also that this insider selling comes because the global equity markets are starting to factor in the reality of a Chinese slowdown? We've talked about a slowdown in China. It seems like the numbers are coming in. Are the stock markets preemptively reflecting something more?
If it's not that, it's at least investors on a wait-and-see course until key leadership roles are determined and a clear political and thus economic path is chosen in China. You have Taiwan, you have Australia, you have South Korea, you have Hong Kong. All of these equity markets have failed to see new highs, and actually over the last 12 to 36 months have been in decline. The one standout would be the Filipino index, and that's a nod to my dad. He spends a lot of time in the Philippines.
Right.
It's the only Asian standout. Everyone else, and particularly those who have very high trade with China, they're in decline. Australia is a major canary, and we watched the press from BHP with great interest a number of months ago as they basically said, their orders for iron ore from China were in steep decline. This is, again, if you're looking for canaries in the coal mine, we have plenty of them.
So what you're talking about is the economically sensitive stocks, machinery, materials like you were talking about, or those companies that produce those types of things actually are not making new highs at this point. They're sort of stagnating or falling.
Exactly. And if you look at some of the chart patterns, whether it is for a BHP or a Freeport-McMoRan, these are companies that are very, very primed for economic growth. And when you don't have that economic growth, there's also some real vulnerability. So the real vote of confidence in the return to growth and prosperity, that story, we're not seeing it. We anticipate that story will ultimately prevail, but not without the pipes getting cleaned out. And that's what we're talking about in a sort of deleveraging process. The pipes get to get cleaned out. Corporations that have bad debts, that debt goes away. Banks that have bad debts, that debt goes away. We're talking about failures, unfortunately, and there is a real human cost to that, and we don't take that lightly by any means. But we do have now sovereigns. Of course, this was the big deal in 2010 and 2011, that it was sovereigns which for the first time were fiscally challenged and countries were hanging on by a thread. Well, their equity markets still reflect that. You look at that in Europe, and Germany's the only one that you can see some sort of a recovery story showing up in their equity markets. If you're looking at France, if you're looking at Italy, if you're looking at Spain, if you're looking at Greece, the best you have in those equity markets is a dead cat bounce.
Well, and you look at what we were talking about are real companies that produce real things like machines, materials, that type of thing. But there is this portion of the market, David, that's built on paper, that it's almost like a drug addict. It's sitting there, and I'm speaking of the financials, okay? The guys who are waiting for the next bailout dollar. They heard about QE1 and they said, well, of course, we had to do it. They heard about QE2 and they said, well, of course, we have to do it. It's going to create a recovery, which it did not. Okay, but the talk right now, the financials are just waiting for their next injection called QE3 or something. Maybe it'll be a generic drug off the counter. It isn't called QE3, but it's the same thing. So they're going to rise and fall, aren't they, with stimulus from the government?
That's true. They're highly geared, just as we talked about the economically sensitive stocks and being highly geared to a growth thematic. The financials are highly geared towards a cheap money thematic,
right.
Cheap money from the Fed. So it is a lot like a drug dependency, if you will. And I think, unfortunately, many asset managers have begun to recalibrate expectations and view your financial sector as now undervalued, looking at Citigroup, looking at Bank of America as a reasonable play from, say, $8 on the share to $12 in their opinion. And, of course, as a rate of return, a good 50%, they would consider that potential on the current price to be, quote-unquote, undervalued. The better question, in my opinion, is to ask, why are the financials, why are the brokers, why are the insurance companies not doing better in light of record stimulus received? I mean, we're talking about monumental sums of money. In fact, in world history, we haven't had this kind of money thrown at the markets in terms of a reviving process, and yet we can't barely even get Bank of America off the floor. It sold at $45 a share in 2008. It still remains under $9.
Well, yeah, Dave, the fall has been resounding. I mean, $45 a share down to $9. And now these guys are saying, well, then that means it's undervalued. But there is a reason. It's like what we talked about before. There's a reason these companies, these corporations have all this cash and aren't spending it. There's a reason also why these financials who've been infused with massive amounts of money. I mean, the only guys who really were bailed out in this bailout were the bankers. Yet their share price is still $9 in comparison to $45 after all this time.
Kevin, I think they moved from 3 to 9 on the basis of creative accounting and those stimulus efforts. But you don't go from 9 to 45 again unless you've got something fundamental backing you, and that's a credit cycle which is supportive to growth in the economy. Lending going to levels that we saw 2007, 2008, and the decade or even 2 decades before that. That's only going to happen if you have structural support. You don't have structural support. You've got stimulative support directly from the Fed, and even that, they're now willing to take their excess reserves and throw them at the economy, lend them out into the larger economy, and create credit. It was one of the key points made by Russell Napier last week, is in his view, we have the death of credit right in front of us. We talk about the death of the dollar. We've got the death of credit right in front of us because banks are not doing their job, which is to take that capital and lend it out to small businesses and individuals who then grow the economy organically. Not happening. So there is a step which is missing in the sequence, which many investors on Wall Street assume is there. Liquidity created equals growth in the economy. The problem is the step that they're filling and the gap that they're filling is that the banks, which get that liquidity, are supposed to lend it into the economy, and that, in fact, is not happening. There is no lending. The mechanism is still broken. It's been broken since 2008.
So the question would be, what is the Fed and the ECB hoping for? Okay, you continue to print money, hand it over to the banks. It doesn't go anywhere, and the share prices aren't recovering, not only for the rest of the economy, but even in the banks. So what is the hope as they continue to stimulate, or are we going to see a reversal in policy, Dave?
It's difficult to say, Kevin, what exactly has been intended, but we do see a massive consolidation of power in the banks. We've talked about this in the past where your major banks have grown in terms of assets under management. The scope, the scale, the size of these businesses is even larger. These too big to fail organizations have grown even bigger in the last 3 to 4 years. So I don't know if that was the intended course that the Federal Reserve had for the commercial banks, but that it has been and remains a benefit to the banking community, not necessarily to the larger economy or the economy at large, but the banking community has gotten larger in this context.
You know, David, I'm sitting here thinking about a metaphor for this because this has been a strange year. We keep seeing this leviathan of government grow. It's going to be growing quite a bit more. We see this, if you want to use the same word, there's a leviathan of excess money that just keeps being put into the system. But you know what it reminds me of? I saw a film clip one time of these guys who were trying to move a dead whale off of the beach, okay? And they tried a number of different things. You know, they brought in heavy machinery and it wouldn't move. They tried a bunch of things. Finally, somebody just stuffed it full of dynamite. Okay?
I was just going to say, the only way to get rid of it.
Well, yeah, and the problem was they put too much in, okay, and it blew it to where people, I mean, camera crews and everybody were getting showered with these fragments of whale. But you know, I'm sitting here thinking, all right, if you're the Federal Reserve and you're trying to get something going, it ain't happening, okay? What do you do? If you're Bernanke, yeah, okay, so you print a little bit more money, maybe get Obama reelected, you know, take the pain away for just a little while longer. If you're a corporation, you're sitting on all this cash, but you're not looking at growth. And so you're sitting there going, okay, how do we move the whale? And, you know, I don't know if that's a good analogy or not. But
well, unfortunately, we don't have the dynamite option as an option. But I think we can anticipate something that's very critical. As we look at these cash balances on corporate balance sheets, given what we talked about earlier, sort of the developing economic conflict zones, you've got companies doing something smart, adapting and changing and keeping their cash flows and continuing to build their cash flows outside of the economic conflict zone. What am I talking about? Mm-hmm. That's the area, or any area of the world, where the battle lines are being drawn between private capital development on the one hand and public capital need on the other, where you've got this conflict and competition for limited resources. And if I can just go back to a critical element of our conversation last week, the sobering conclusion from the conversation with Mr. Napier is that wherever you are in the world, if your government will have to take your wealth to fill the fiscal gap, you should remove your capital from that country.
Right.
And this is something that's been a theme in theoretical terms for us for decades. This is something that Don has harped on going back to when I was probably 6 years old, which was, yes, decades ago. And this is the amazing thing. Some people listen and some people don't. But theoretically, it was a risk. Governments come into tough times and they get very grabby. So make sure that you don't have all of your eggs in one geographic basket. That was in theory. Now we have governments that are getting grabby. It's no longer theoretical. What's your choices? It's very clear what an investor needs to do. They need to move from theory to practice, quit theorizing, quit thinking about what could happen to them, and instead look at what is likely to happen to them in this period where, again, the battle lines are being drawn between private capital and public capital needs. And I think this is, Kevin, where we need to look very seriously at what our options are.
Well, David, that's exactly right. You have recommended for years, and Dawn has recommended for years, having some assets overseas. Of course, you know, it's never been for secret reasons, or, you know, it's not a secret type of play. It's something that's fully reportable, fully legal, but it is outside of the country. And, you know, Russell Napier, that was his point last week. He was saying, you know, if you think the government's going to go bankrupt before you do, you're mistaken. Okay, the government's going to get what they need to get to continue to survive, and that could be through capital controls, it could be through taxation, it could be through a number of things. In fact, he was talking about it could be quite subtle in the form of financial repression, where you're just not getting a real rate of return and wondering why you can't come up with the amount of money that you need to get to the end of the month.
Kevin, our skepticism, frankly, doesn't have sort of national boundary markers where we're not really criticizing the U.S. government in this regard. We're saying that if you live in Mexico, you should have a part of your assets in the United States, or better yet, in Canada, or better yet, just pick it anywhere else. If you are a U.S. citizen, you should have some of your assets in Canada, in Switzerland, in Singapore. If you're a Swiss citizen, you should have a part of your assets in Italy, Spain, England, someplace else, some geographically different location. If you live in India, you might want to have some of your assets in Singapore. You might want to have some of your assets in Switzerland. If you live in China, you may want to have some of your assets in Hong Kong, although that may not be far enough. The point is to have a realistic appraisal of your government, whatever that government is, and take the steps necessary to have seed capital for the future, whether that's to build an enterprise, to build a business, or to just restart. This has been the tradition of your wealthy, old European families, the smartest ones, were the ones who took a part of their wealth and diversified into another country, built a new business there, built a new franchise, or simply just relocated assets.
Well, and of course, David, one of the great risks throughout history of having money elsewhere is just the currency risk. I mean, if you had it in Germany or Switzerland or, like you said, Singapore, China, what have you, a lot of times people go out and they'll actually just put it in that currency. Well, they're actually taking a long-term bet that that currency is going to be better than the dollar or whatever currency they're coming out of. But historically, the people who've stored gold overseas have found that that takes out the currency risk.